Good morning, James. Welcome.
James, how are you?
Very well, thank you. What a volatile start to the year it's been for the first two quarters, specifically in the government bond space. And I'm just trying to get a sense from you what the macroeconomic outlook is for the markets today.
Yeah, sure. Well, let's not kid ourselves. Bond markets have had a shocker for the first half of 22. You know, the indices were down in the order of 10 to 12%, depending on which country and jurisdiction you were looking at. Credit markets, obviously, even worse. We're coming to a point in time now where it's textbook late cycle. And what does that mean when I say textbook late cycle? That means we're ticking things off. So we got commodity prices coming lower, we got property prices coming lower. Short end rates are starting to peak, if not peaked already. Inflation's starting to come off, and consumer confidence is really getting hit quite hard as well, which is all coming through on the data.
Yep. Okay, and then from a return expectations, obviously we've seen yields back up, so we're starting to see incomes being restored, and then JCB starting to witness some inflows coming into the product. So it'd be good to get a view from you on that as well.
That's right. Well, the idea and the premise of fixed income securities is that they are, as their name suggests, a fixed income paying security, and they make their money from the coupons that get paid every 6 months, as well as the carry and roll over time. Now, the first 6 months of 2022 saw, as we mentioned, the worst returns pretty much in the history of bonds, going back hundreds of years. The premise of this carry and roll and the coupons wasn't able to keep up with the capital sell-off. And so what we do expect in the second half of the year is that the sell-off will abate, if not stop, and potentially reverse. But the premise of fixed income securities means the returns will start to become much more positive going forward. We got central banks hiking into slowing growth profiles, which is just a disaster for economies, and recessions are the next thing on the horizon.
Okay, and then casting our mind back, we've gone through a couple of major episodes of market volatility, specifically late 2018 and early 2020. We saw credit spreads widen and then tighten quickly. Should we expect that performance this time, or is it different?
Oh, look, I know we always say it, and this time is different, but we are coming from a very, very different set of circumstances where inflation is the problem.
Okay.
So beforehand, in 18 and 20, we were at levels where we had a bit of room to cut rates because cash rates weren't at zero at the time. In 18, the US Fed funds rate got to about 2.5, and so they said they were going to hike. They said the governor at the time said they were a long way from neutral, but ended up pivoting pretty quickly, and they were able to cut rates from 2.5%, back to zero by the mid of 2020. This time with inflation where it is, printing in the 8s. We've got another print this week. Could be high 8s, maybe potentially 9%, depending on where it falls out. There's no room for them to be cutting rates, which means credit doesn't have the cushion to fall back onto, which means that in the event that companies do need to roll debt, so their short-term rolling debt, it's going to be very expensive for them, and defaults are a very, very high potential.
Okay, great. And then I guess it's strange to say this, but we've seen declines across the asset markets, but it's been quite orderly so far, and markets are functioning well. Should we be worried about an event like a seizure event on the horizon?
Well, I think it goes back to the credit story versus the sovereign bond story. So sovereign bonds they're actually performing quite well, although the MOVE index, which is effectively the VIX for bonds, is at levels not seen since 2020 during the COVID crisis. Credit markets are slowly selling off, and they're reaching very wide levels as far as spread to treasuries go. But it is going to get to the point where corporates and people and governments are going to need to roll their debt, and that's what's going to cause the big defaults in time.
Are bonds still a defensive asset in the traditional sense of a 60-40 portfolio, James?
Look, they are. During the COVID crisis in 2020 especially, bonds did their role as they were supposed to. So, they offered opportunities for people to sell assets at a premium to buy deeply discounted risk assets at the time. And, that worked out very well for a lot of people. This time, they will continue to provide that defence. It's obviously had a very poor run in the first half of 22. But what we do know about bonds is that bonds are mandated to pay their coupon every 6 months, which will happen over the life of their bond, unless they do default, which is not going to happen with the sovereign. But what we know is that dividends are not sure to be paid. So over the second half of 2022, we do expect bonds to perform. They should outperform their riskier assets until we do see some sort of pivot from central banks, which is still a long way off with inflation where it is.
What is the end game, and what are the scenarios that might play out?
Yeah, look, the end game for now is that central banks will keep hiking to destroy demand until something breaks. And so they're hoping, and it should happen, that if they can hit demand as hard as they can, that will reduce the problems with supply chains, which will in effect reduce the whole inflation chain. So we would expect to see a period of disinflation towards the end of the year. Inflation's a real pendulum at times. So we've obviously come out of 2020 and we've gone too far that way, and then in time it does cycle back towards disinflationary. The long-term factors in inflation, so globalization and demographics and technology.
Yep.
They're still going to be at the forefront. So at some point it will come back to a more even playing field between that disinflation and inflation. The scenarios that we can see playing out, there's probably three key ones.
Okay.
One is that the aggressive pricing in cash rates will not be met. So we've had Australia with a cash rate price in the order of 4 to 4.5%. It's back off now, and if they can avoid getting to there, then we may get a soft landing. Second scenario is that we see a central bank induced recession, which is also probably our base case at the moment, which means it's going to hike too hard, destroy demand, which will then bring the world into recession sometime in 2023. And the third option is that inflation keeps going higher, central banks keep hiking, bond yields keep selling off. Well, we don't see that as the likely outcome. It's one thing to have the economy humming along at when cash rates are at 1.5% to 2%. If cash rates get to 4.5%, it's a very different story, and that big crescendo in credit events and other risky assets is really going to get hit hard.
Yeah, right. And then taking that further, what data prints and what events are you looking at into the future to kind of signal some of those things that you mentioned, those three scenarios?
Yeah, well, we're looking at things like durable goods, so what's being manufactured. We're looking at supply chains, so there's some good data, some real-time data that we see on that. We're looking at money supply and credit momentum, which are just falling off a cliff at the moment. Obviously, we're looking at CPI, which we get another read on this week, and we're looking at jobs numbers, which came out last week. No, they were a little bit high, but in the current environment, we're actually seeing that sometimes good news is bad news for risk assets, because it means that the Fed's just going to have to do more, which is quickens up the cycle and means things are going to come back to earth quicker. And then from a rate side, we look at inflation break-evens, which is expected inflation rate in years to come. So the 10-year break-even inflation rate, for example, in the US is in the low 2%. So we're not pricing anything like the 8% that's being seen at the current prints, the monthly print numbers, and markets are in its most efficient ways looking for inflation to peter out in the next sort of 6 months to 12 months.
James, what are our investors kind of saying to you and doing as well with their funds? It'd be really interesting to know.
Yeah, well, the bond guys have all of a sudden turned to rock stars in the environment. We're usually the part of the portfolio that no one really wants to speak about or speak to, but with such large moves in the first half of the year, and also people coming to the understanding how much bonds do drive overall asset performance, then we're definitely front of mind. From a flow point of view, we've seen a lot of both retail and institutional interest. So we've had steady inflows into the fund, which have been very pleasing. And when you've got a 10-year bond up at 3.5% to 4% on a continuously compounding, self-correcting asset, then it's a great time to be putting your money into the bond market.
Agreed. Well, James, thanks for your time. We really appreciated your insights and the key events to look out for the next half of this year. Thank you.
Thanks, James.